Welcome, everyone, to our insightful journey into liquidity preference. Let's begin by understanding what liquidity preference means. Imagine the choices people face between holding cash and other assets like property or stocks. This theory explores why many prefer cash or highly liquid assets that can be easily converted to cash. The convenience of quick access to funds and the flexibility it provides are just a few reasons. Why is this understanding crucial? Because it shapes how we view financial markets, investor behavior, and economic stability. As we move forward, you'll learn how historical context gave rise to this theory, its evolution over time, and its present-day applications. Stay with us as we unravel these concepts further, starting with the intriguing origins of liquidity preference. The concept of liquidity preference dates back to the early 20th century, emerging as a cornerstone in economics. It was notably advanced by the influential British economist John Maynard Keynes. Keynes illuminated why individuals and institutions favor liquid assets, especially during financial uncertainty. His key work, The General Theory of Employment, Interest, and Money, published in 1936, highlighted the role of liquidity in economic stability. Economists like Irving Fisher and Knut Wicksell also shaped this idea, laying foundational views on interest rates and liquidity. Together, they've influenced financial policies and market behaviors for nearly a century. By examining their contributions, we can trace the evolution of liquidity preference theory and its lasting impact on modern financial practices. Up next, you'll see how these early insights paved the way for subsequent developments in financial theory. Over the years, liquidity preference theory has evolved, incorporating new insights and refinements. Initially proposed by John Maynard Keynes, this theory has undergone significant development, influenced by various economic thinkers and changing market conditions. As the financial landscape has transformed, so has our understanding of why investors favor liquid assets. Key refinements have considered risk, market behavior, and macroeconomic implications. This evolution showcases the theory's flexibility and adaptability, making it more relevant for modern economics. By examining these developments, we gain a deeper appreciation for the theory's complexity and its role in financial decision-making. Next, we'll explore what constitutes liquid assets, providing clear definitions and examples. Stay with us as we build on this foundational knowledge and uncover the intricacies of liquidity in the financial world. Now let's delve into liquid assets. These are assets that can be quickly and easily converted into cash without significant loss of value. Examples include cash, bank deposits, and marketable securities like stocks or government bonds. These assets are crucial for meeting financial obligations promptly and provide a safety net during uncertain economic times. Understanding liquid assets helps you manage your portfolio effectively. In the coming segment, you'll see how liquid assets compare to less flexible counterparts, the illiquid assets, and why this knowledge is essential for financial management. Illiquid assets, on the other hand, cannot be quickly converted into cash without significant loss of value. These investments often require time and effort to sell and come with high transaction costs. Common examples include real estate, which can take months or even years to find a buyer, and private equity, which involves intricate sale processes. Collectibles, such as art and vintage cars, are also illiquid as they appeal to niche markets. Understanding the nature of illiquid assets is crucial for investors and businesses. This knowledge helps balance the need for liquidity with the potential for higher returns. In the next segment, we'll compare liquid and illiquid assets, highlighting their unique advantages and disadvantages to help you navigate investment strategies more effectively. Let's dive into the comparison of liquid and illiquid assets. Liquid assets, like cash, bank deposits, and marketable securities, provide quick access to cash with minimal loss in value, functioning as your financial safety net. However, this convenience often comes at the cost of lower returns. Illiquid assets, such as real estate, private equity, and collectibles, tend to offer higher returns but are harder to convert into cash quickly. Selling real estate overnight, for example, is a challenge that often involves a significant loss in value if rushed. Balancing ease of access with potential returns is key. Liquid assets provide flexibility and security, ideal for unexpected expenses and urgent investment opportunities. On the other hand, illiquid assets can fuel long-term growth. Next, we'll explore the modern applications of liquidity preference theory, uncovering its relevance in today's financial markets. In today's financial markets, liquidity preference theory remains profoundly relevant. Investors often seek liquid assets during economic uncertainty, valuing the security and flexibility they offer. This theory helps explain why, even in modern markets, assets like cash and government securities are highly favored. During market downturns, there's a noticeable shift as investors move from illiquid assets like real estate to more liquid options. This behavior aims to minimize risk and maintain quick access to funds. Consider market reactions during recent economic crises. Liquidity preference shaped those outcomes. Understanding this theory allows us to anticipate market trends and investor behavior more accurately, informing better strategies and decisions. As we move forward, you'll see how it continues to shape financial strategies. Next, we explore what the future holds for liquidity preference and its potential impacts on global financial markets. Looking to the future, liquidity preference will remain influential in the financial world. It's not just a historical theory, but a dynamic framework guiding investor behavior and market movements. Global financial market evolution requires a deeper understanding of liquidity preferences. Whether navigating economic volatility or capitalizing on emerging opportunities, liquidity preference offers a lens to understand future developments. It's crucial in anticipating trends and shaping strategies, providing insights into the balance between risk and return. Potential shifts in liquidity preference impact asset pricing and market stability. As we delve deeper, pay attention to how these shifts affect financial landscapes. Next, we'll examine liquidity preference alongside other financial theories, offering insights into why liquid assets are highly valued. Let's compare liquidity preference with other financial theories. While traditional theories emphasize returns or risks, liquidity preference delves into the psychological comfort of holding liquid assets. This theory explains why individuals prioritize assets that can be readily converted to cash. Other financial perspectives focus on growth potential or risk mitigation. For instance, the capital asset pricing model, (CAPM), targets the relationship between risk and expected return. In contrast, liquidity preference highlights the peace of mind provided by quick access to cash, especially during uncertain times. Compared to modern portfolio theory, which promotes diversification to maximize returns, liquidity preference underscores the value of flexibility and financial security. It stands out by considering human behavior during market volatility. As we move forward, you'll see how this unique focus on liquidity shapes our understanding of market dynamics and investment strategies. In conclusion, understanding liquidity preference is crucial for grasping financial market dynamics and investor behavior. We've explored the origins and evolution of this theory, distinctions between liquid and illiquid assets, and its modern applications and future implications. By comparing it with other financial theories, we've highlighted why people prefer liquid assets. Liquid assets offer quick access to cash but may come with lower returns, while illiquid assets might provide higher returns with less flexibility. Going forward, the principles of liquidity preference will continue to shape financial markets and influence investor decisions. Thank you for joining us. We hope this exploration enriched your understanding and provided valuable perspectives on liquidity preference. Stay curious and keep learning.